Alright, what's up guys, this is Social Ham here. So today we're going to be doing a video on taxes. Now, this isn't a definitive list on taxes. This is just going to be some short terms. I'm doing this not for you to know how to do your taxes. This is simply just so you get some vocab and some know-it-all when it comes to certain tax terms. This one's going to be focusing on income tax. I was going to do one doing corporate taxes, income taxes, excise taxes, but I figured that'd be really long, so instead I'm going to cut it up into short chunks, and so there'll probably be a video once a week about some form of tax, probably for maybe the next 3 weeks. It's supposed to go up yesterday, but I got a new PC, so I was busy setting that up. And that's going to be for streaming later on, which I'll let you know about, and also just YouTube and stuff, and for gaming in general. But I do have the video ready for you now. This is also just going to be on, like I said, income taxes, and it's on PowerPoint. This is very professional. So, basically taxes. Simple terms, like I said, on taxation policy, and then this is just stuff you should know when you're having discussions. If you're ever reading a news article or reading a bill that Congress is trying to introduce, and there's a tax term in there you don't know, this should help you out. So, first of all, what is a tax? I know it seems very simple, but some people might generally not know. It's simply a compulsory financial charge imposed on you by the government to fund the government and public expenditures. Basically, tax is just saying we're going to take this small percentage of money. Compulsory means it is enforced by the law, so if you don't pay the tax, you will get in trouble. And they use that to fund stuff in the government, whether that's something, for example, like building the wall that Donald Trump wanted, or maybe if we want to invest in free college, stuff like that. These are from the government, public works, and other public projects, and there are multiple types of taxes. Like I said, this video will only be going over the types of income taxes. This is also, again, not definitive. There are other income tax types, but this is like the most common ones, or the ones you probably hear Congress people and news people cover. So, income tax. Very plain and simple, it's a tax that each individual who's working must pay based on their annual income. And it's the US's biggest source when it comes to taxes. So, here you can see, this is all the tax revenue that the United States picked up in 2019. As you can see, we have 41.5% of individual income taxes. And if you want to take it a step further, the social insurance taxes, this is Medicaid and Social Security, which I'll get into a little bit later. So technically speaking, they get most of their money from just individuals. This is about 66% of taxes come just from each single individual. The others are so irrelevant that there's not even 0.1%. You have 3.9% in corporate taxes, which again I'll go over in another video. There's 12.1% from property taxes, which I will go over in another video. Property taxes, simply put, is stuff like your housing and other assets like that. Consumption taxes, 17.6%, is another video we'll be going over soon. So, there are three general forms of income tax. So you have the federal income tax. This is collected by the federal government for the federal government to spend. So when they talk about how are we going to fund free college, or how are we going to fund renewable energy that the government's going to spend on, this is where that money would go towards it, your federal income tax. There's a percentage taken out of your income that goes to the federal government. Then, depending on the state you live in, there are state income taxes. So I live in Florida. We don't actually have a state income tax, but if you go to a state like New York or California, they do have state income taxes. So on top of the federal government taking a percentage of your money in your income, the state also comes in and takes a percentage of that to fund, again, the state, whatever state projects they want to do. Let's say the state wants to build a new highway. Maybe the state wants to introduce electric car chargers around the state. That's where the money would go towards. And then the rarest type is the local income taxes. These are collected either by municipalities, counties, or school districts to fund either the city or the municipality that the tax is being taxed on, or the schools. So a lot of schools are taxed, a lot of schools get funding via property taxes, but some school districts actually just go ahead and tax the people that live in it and that go to that school district, and so they get money from the people that live there. This is not that common. It's the least common of these two. Obviously, the federal income tax, no one can escape. State income taxes depends on the state you live in. You should look up to see if you do have a state income tax. And then local, depends. You can check as well in your city. I believe Miami does not have a state income a local income tax. It's the rarest of the bunch. So, how does the U.S. tax people? Now, obviously, there's the IRS, as in like who actually collects the taxes. But the U.S. taxes people on what is called the marginal tax system. So essentially, you are taxed a certain percentage depending on what bracket your income falls in. However, a lot of people think that there's a tax basically on all the money you earn. And this is the common misconception, and I'm going to go over right here with this chart. So this is the chart for 2021 to 2022. This is the rate at which people would be taxed at. So let's take, for example, right over here at 24%. So if you make anywhere from $86,376 to $164,925, you're getting taxed at 24%. Now, what most people see this, they think, oh, okay, so if I'm making $150K, then I'm going to be paying 24% of taxes of my $150K. That's actually not what happens. So the way a marginal tax system works is you're taxed a certain amount per bracket. So someone who made $150,000 in a year, their first $9,950 will be taxed at 10%. Then any money they make after $9,950 up till $40,525 will be taxed at 12%, and so forth. So you're not actually taxed the simple bracket you fall in on the upper end. You basically get a percentage of each individual bracket. And here you see, for example, someone who's making, let's say, $200K, they're going to be paying a base $33,603 in taxes due to the brackets of these, the maximum amount you can pay in each bracket. And then after they get to $164,926, whatever other money they make in that bracket up until they reach $209,425, they'll be taxed at 32%. So no one's really taxed at just one base percentage unless you're making less than $9,950 in a year. And a lot of people don't know that. A lot of people just think that, oh, I make $100K, so that means I'm paying 24% taxes. That's not actually true. You'd technically be paying just a little bit less. So, are there other forms of tax on income? There actually are. There's the payroll tax and the capital gains tax. Payroll tax is the taxes on your wages and salaries to fund Social Security and Medicare. I believe, I could be wrong, but I believe these are the only things they're used to fund, and other social programs. Capital gains taxes are taxes on your realized gains on any of your personal assets or investments, and we're going to go over those in a little bit. So, payroll tax. Payroll taxes is essentially just a tax on the wages and salaries of employees. So if you ever have a job and you get your pay stub, you're going to see the net income you get, which is how much money you made. So for example, if you make $10 the hour and you work 10 hours in a week, your net income will be $100 on your paycheck. But then you're going to get a thing called your FICA tax, your FICA removed, which is the payroll tax. And that is the money that goes towards Social Security and Medicare. In the US, 12.4% is tax on your wages to fund Social Security, and 2.9% is used to tax Medicare. So that means in total, of your $100, 15.3% would be taken away from you to go towards Social Security and Medicare. However, pretty much universally, your employer pays 7.65%, half of the 15.3%, and then they take out the remaining 7.65% from your paycheck. So, in the example I gave, let's say you made $100 in a week. Based off the percentage, you would owe $15.30, but your employer is paying 7.65% of that. So your employer would actually be paying $7.65 on your part, and then you would pay the other $7.65. So that's how that works. If you ever want to know, it's really simple. Just look at your paycheck, and you can look at the amount, you can do the math, and it'll work out. The last one is the capital gains tax. Now, if you're on the younger side, this probably isn't something you're going to have to worry about, but it's still good to know because usually when people talk about taxing the rich or taxing wealthy people, they usually want to talk about the capital gains tax and not the income tax, because wealthy people usually don't make a high salary because they have money in assets and their net worth. So it's basically just a tax on your assets. So let's say I buy a house. My house is worth $300,000. That is an asset of $300,000. Now, let's say 5 years down the line, my house goes up in price, and now my house is worth $500,000. The amount it has gone up is what we would call the capital gain. So my house used to be worth $300,000, and now it's $500,000. Therefore, I got a capital gain of $200,000. Assets typically include cars, houses, big pieces of art, costly, expensive pieces of art, and then most notably, stocks and bonds. Now, when you get your capital gain, when my house is at $500K, I don't pay anything in taxes. But upon selling it, which is realizing it, that is when the profit amount would be taxed. So, it's kind of a double tax. So when I first buy the house for $300K, I will pay the taxes on that house. If I then sell the house at $500K, I will then be selling the house for the capital gain, which is at $200,000. There are two types of capital gains. There's the short term, which basically, if you own your asset for 1 year or less, you're going to be taxed at the same rate of your tax bracket. So, for example, in my scenario, to make it a little simple, we'll say $100K. If you make $100,000 in the year, you'd be at the 22% tax bracket. Upon selling it, you will have an additional $100K, so of that $100K, 22% will be taxed. If you have a long-term asset, you will be paying a tax anywhere from 0 to 20%. A long-term asset is considered anything that is over a year. So if you hold a stock or some bonds for over a year, they now become a long-term capital gain. And here you can see the chart. It's based on your income, and it's also based on if you're married or not, which is taxes are always based on that. So you can see, supposing you have a capital gains of $400K and you made somewhere between $40,000 to $445,000, they're just going to tax you 15%. So if I made $100,000 of my capital gains, my long-term capital gains, and I made somewhere like $50K around the year, then I'd be paying 15% of the $100,000 I made, which would be $15,000. So I hope that wasn't too complicated or too frustrating. I know it was a lot to take in. Taxes are a little bit complicated, but I can assure you, now you're going to know a little bit more. If you ever read an article and someone mentions capital gains, if they ever mention what's a long-term or short-term, then you have a little bit more knowledge, and hopefully it'll help you out in the long run. So, thanks for watching. I hope you guys enjoyed, and I'll see you in the next video, alright?